Welcome. Looks like everyone's jumping on. We'll give it just a couple seconds. Just want to thank everybody for joining us for part of our Realtor Growth Series for this one's Insurance IQ, as you guys know. And I'm Kelly Smith. I've been with Mountain West for 11 years. It'll be 12 years the beginning of next month. So I've been in the mortgage industry since I was 16. I will not tell you how many years that is because I don't want you to know how old I am. So, but we have some great things planned. So I'm going to go ahead and I will jump in for you guys and get our lovely speakers and introduce them. So I just introduced myself, and we also have Ben Holloway who's going to be speaking today, and he's our executive vice president. And there he is. Hi, Ben.
Good morning.
And great thing about Ben, a little bit of a little tidbit, as he started at Mountain West as a receptionist, and he has done pretty much a little bit of everything at Mountain West, as far as he was a branch manager, obviously, as being a loan officer, he's ran departments, and now he's on our board of directors. Ben is amazing in the fact that he is one of our most tech savvy people I find, and a wealth of knowledge. So it's really exciting to have him on here because he can show things from an operational side. Also, he knows how to wear that sales hat and keep it where we can give great customer service to our clients. And last but not least, we have Darnell Ferguson. And he is amazing as well. Darnell is the president of Fast Forward Insurance, and he's been a long time friend and partner with Mountain West. And he's been a licensed agent since 2012. He does a little bit of everything when it comes to insurance. He has worked in all demographics throughout the United States. So he is a wealth of knowledge in bringing us information on a little bit of everything when it comes to insurance. So we're really excited to have you guys. Thank you both for being here. And just to go over our agenda, we're going to keep this pretty open, so feel free to ask questions if you guys would like in the chat box as we see those. And then we will have moments after the presentation to ask more questions. But this is a casual, this is meant to be informative for you guys, so you guys can learn information and get what you need out of it. So if you guys have questions, feel free. We're going to go over basically how the insurance market works. There's a lot of information that we don't know, so we'll go over those things, different structures of how that works. What does the insurance commissioner do, or what don't they do? And also the logistics of the FAIR plan, which is a real hot topic. Even though that is in California, which is a major hot topic, there is FAIR plans in other states. So we just want to reach on that. We don't know how this insurance business is all going to work years to come. So I think it's important for us to cover that. And then Darnell's going to give us a moment to go into some deep questions of what he sees on the insurance side that we can do, that can help us, and basically why we're in this situation that we're in. And then last but not least, what we can do for you guys, what you guys can do as an agent to help transactions move smoother, how you can then, help your borrowers and our clients in the long run as well through homeowners insurance. And then we will obviously go over questions again. So I'm going to let Ben take it away and go over this stuff. And welcome, Ben.
All right, thanks, Kelly. Appreciate it. Glad to have everyone on the call here today. Hopefully we can bring some good value to you, a little understanding of what's going on, and also just the ability to help navigate some challenges or avoid some challenges you're working your transactions. And as Kelly mentioned, please, raise your hand or say, I've got a question, or if you have, blurt it out, kind of pause us. This is meant to be interactive. So we're, looking forward to any inclusion that we can. So first thing wanted to talk about was just the insurance market itself, and then the three different types of insurance agencies that are the most common out there. First is just from a really high 35,000 foot level, understanding the insurance market. The basic system on that is that the insurance companies charge premiums, on a homeowner's insurance, auto insurance, whatever that's going to be. And they charge all these premiums, and they pool all of those funds together. And then when they get all those funds pulled, they go out there and they make investments. They invest in real estate. They might invest in businesses, whatever it is that they feel are good investments. They put those monies to work. And then part of the other side of that business is that they have to pay their premiums if there's any sort of or pay claims, if there's any sort of a claim against the property, they have a loss. And so the difference between what they collect, what they pull and put out as investments, and then what they have to pay out for claims equals the insurance profit that they're going to have. And so as a whole, just to kind of give an idea, the insurance world, they have about a 7% margin for profitability on average. So we're going to talk about some really big numbers today. And so it's just important, I think, to also understand that, with some of the increases in costs, these insurance companies, their profit margins haven't changed a whole lot, even though a lot of the premiums have gone up. So we'll share some information on why that is, and that'll help to, I think, navigate some conversations you may have with other realtors or with your customers, things like that. All right, so the first to talk about, just as far as the type of an agent, is a captive agent. So if you're working with agents out in the marketplace, a captive is someone who works for like an Allstate, State Farm, Farmers. They've really got a controlled offering that they can do. So if you work for Allstate, you pretty much offer Allstate products. Work for State Farm, Farmers, etc. Then there's independent agents. Independent agents are appointed by multiple insurance carriers, and what's important is that we mentioned that that's done at the same time. So an independent agent can represent multiple carriers at once, like a Mercury, Traveler, Safeco, Bamboo, Berkshire Hathaway, whoever that might be. And what's unique about them is that they're able to issue evidences of insurance as if they were a direct employee of those carriers. So they have binding authority. And then the other one is a broker. And so a broker is someone who has access to the insurance markets, and they will reach out to carriers when they have a new customer, and they will arrange for that policy to be done. And if the consumer likes the quote, they'll tell that carrier, hey, yes, we want to move forward. And a couple days later, same day, 3 days, whatever that might be, that evidence of insurance is issued by the carrier directly. So they all have their important roles in the market. I don't want to say one's better than any of the others. It's just good to understand, really what how they're designed or structured inside of the insurance market. So as you're dealing with these agents, you have an idea of what their limitations or capacities or advantages, might be. And we can either change a slide or answer questions if anyone has them. If not, we'll just keep on pushing. All right. One thing to share about the insurance business, I was doing a little research before our meeting today, and from a property and casualty perspective, the insurance business was $700 billion in premium on an annual basis right now, just for property and casualty. So that's your home and autos and such. And to talk about the size and changes of premium that have happened in the last couple of years. So from 2005 to 2020, there was a $1.5 trillion increase in premiums over that 15-year period. And so at the end of 2020, 5.23 trillion is the amount of premiums that were collected for that year. And again, they'd gone up 1.5 trillion over a 15-year period. If you fast forward to 2022, and this is specific to California to give you guys some point of reference, the insurance business was a 7 trillion at the end of 22, which was a 1.75 trillion increase over a 2-year period. So what took 15 years to go up 1.5 trillion only took 2 years to go up 1.75 trillion during the COVID era. And that is for all just gross premium written for all types of insurance. I'm giving you guys those numbers. It doesn't dissect it down to property and casualty, but just kind of gives you an idea of the increase that's gone on the last couple of years, and which is leading into a lot of the questions about what's going on with our insurance market now. So, all right. So I guess we'll talk about insurance commissioners. So in the United States, almost every state has an insurance commissioner. There are 11 states that have an elected insurance commissioner, and California is one of them. And one of the things I like to point out that's specific to California is that California is the only state that requires a carrier get approval for rate increases and rate decreases within inside of the state. So we'll talk as much as we can broadly about how the insurance commissioners work and what they do, but there are some uniquenesses that come to California, and we'll touch on some of that. So the insurance commissioner, again, in 11 states is elected. You got California, Delaware, Georgia, Kansas, Louisiana, Mississippi, Montana, North Carolina, North Dakota, Oklahoma, and Washington all have elected insurance commissioners. And the insurance commissioner is there to provide stability in the insurance market within the state that they represent. And they cover all types of insurance, not just home or auto, but they've got medical, life, any type, title insurance falls inside of the under the insurance commissioner as well. So that's the role that they play. And what they're really trying to do is protect consumers. They want to make sure that everyone has the proper licensing and falls within compliance. And again, in California, they've got this rate approval process that you have to, go through. In California, what's unique about it is that the increases are based on prior year earnings or losses. So in California, if an insurance carrier had profit from the year before and they go to ask for a rate increase, they're almost guaranteed to be turned down because they were profitable the prior year. So it makes it tough for an insurance carrier to go into a new market. Let's say they've stayed out of a local high fire area, and now they've decided they want to enter that. And they go to the insurance commissioner and say, hey, we want to start riding in the San Bernardino Mountains. We think we can, write premium in there and be profitable and, give some insurance. And so the insurance commissioner can look at that and say, well, you were profitable last year, so we can't give you a rate increase, even though you would need a rate increase to take on these more high risk areas. And so it makes it really challenging for the insurance carriers to lower their rates or raise them when the process is so difficult to get those changes. In California, there was in 2022, there was 41 rate increase filings that went through, and it took an average of 349 days to get their approvals for the ones that were issued. So you can see where the carriers just feel like, if it's going to take me a year to get my approval and the likeliness of that to go through is low, a lot of them have decided to just stop trying to write new business or have even left the state altogether. Any questions on that? Does everyone mute it, Kelly? Or they have to raise their hand or anything like that? Do you know how they have to be involved with us?
I feel like they should be able to be unmuted. If not, use the chat.
Okay.
Yeah, we have everyone as muted, but.
Awesome. Yeah. So if you guys do have a question, please drop that in the chat and we'll take a second to address that. So a couple other data points for you guys, just with California here, is that California ranks as 24 out of 50 as of 2020 as far as the affordability for insurance. The average policy back in 2020 was $1,241 on an annual basis. I tried to find some data that was a little bit more current, but I couldn't find anything that was reportable in the last couple of years. So they definitely do try to stay in the more affordable range compared to some other states. Mountain West does loans in about 18 states across the country, and we can definitely acknowledge that California does have some of the lower premiums compared to some other states. But what we are seeing happening is a shift in how the carriers are charging premiums. So if you have an insurance premium, let's say in Los Angeles County, or like say down in LA, and we call it, the concrete jungle, right? There's not a lot of wildfire risk there. And then you have another individual who's got coverage in, let's say, local mountains. What they're doing is they're either reducing or maintaining that premium in, let's say, Los Angeles, and they are increasing premium on existing customers in an area to try to offset that risk. So if you can imagine a home that's maybe right next to the national forest, where their backyard, let's say, butts up to the national forest, they might be getting dropped from a carrier because they don't have enough clearance in order to be a safe bet for that insurance carrier. So they're drop them. And let's say that policy that they dropped was, $4,000 a year because that was a high risk area. So now that the insurance carrier has, I'll use the words, freed up this $4,000 in premium from a individual they no longer cover, they'll go find another one of their customers that is not as high risk, but still in an increased risk. And that's where they'll take that and apply that $4,000 in available premium at some percentage to that new household. So that's how the insurance carriers are able to have premium increases to certain customers without getting rate increases from the state. They are dropping their higher risk customers and then taking that available premium that they're allotted and charging that to the existing customer base that they've got. And by doing that, it does keep the average policy rate, relatively the same for the state when you look at it average across the board. But as many of you have probably experienced or are testing, is that the rates for high risk areas has just gone up really dramatically, and that's one of the ways that the insurance carriers are able to increase those premiums without getting their rate approvals.
Hey, Ben, Elizabeth has a question. She is asking, can the premiums go up or down a certain amount or not at all?
The rates that the insurance companies put out for approval through the state, that's like a fixed rate amount. So they can't change that without getting approval from the state, from the Department of Insurance, the DOI. But once they have their, they call it like an allocated premium allowance is kind of the verbiage that's used. Once they have that allocated allowance, they can kind of divvy up what that rate is going to be within their pool of customers. So there's not a restriction that says, hey, if you were at $2,000 a year premium in a high fire zone, there's a 30% max increase, and so you can only go up $600. We've seen those customers go from $2,000 to $4,000, $6,000, $8,000 increases depending on the risk that they've got. So to their rate increases that are filed with the state, yes, there's a limitation, but what they can charge to an individual consumer within side of their allocated allowance from the state, they don't have a limit. And what I mean by an allocated allowance is that insurance companies have to have a capital ratio, a certain amount of cash to the amount of risk that they represent. And so as long as they keep that capital ratio in check, they can, charge what they want to based off of those certain high risk areas. But again, it's limited to the rates that they, have told the state that they're going to charge. I don't know the exact algorithms on that, but that's the basic premises for how they operate. Yeah, you got it, Elizabeth. Good question. Look at my notes here on this slide, make sure everything else for you guys. Oh, last thing, yeah, just on here too, is that in California, California is the only state that does not allow a forward-looking model from the insurance carriers to be able to have those rate increases. Everything is a look back. So that is something that, again, is unique to California. So, all right, I think we can go to the next slide. We missed the fair plan slide, didn't we? There we go. All right, awesome.
I got a little trigger happy there. Sorry about that.
Yep, pushing right along. So the FAIR plan stands for Fair Access to Insurance Requirements. It's a policy or an option that's there for almost every state. So 33 states have a FAIR plan or something like it. And it's basically the last ditch resort for someone to have access to the insurance market if insurance carriers are unwilling to participate in a certain area. So the FAIR plan is how they get around that. What's important to understand is that the California FAIR plan is funded by insurance carriers as a percentage of their market share. And so if California FAIR plan all of a sudden is short on money and they need to raise $1 billion in cash, they reach out to all of the approved carriers in the state and say, hey, we need $1 billion. And for example, State Farm is 21% market share. State Farm would have to come up with 21% of that billion in order to fund the FAIR plan. So, and one of the things that's unique about the FAIR plan is that it is a forced participation. If you want to write insurance in California, you are forced to participate with the FAIR plan. So that's something that's a little unique about that. Some things that are unique to the FAIR plan that I want to talk about just from some data points for you guys is that the FAIR plan in California, put in for a rate increase back in 2021, and they asked for a 48% increase to rates, and the state came back and said, we'll give you a 15% increase. And so again, it kind of gives you an idea of how that works. And that process was not approved until 2023. So again, a long time for them to get that rate increase that they were looking to get. From a size perspective, in 2015, California FAIR Plan had 22,700 policies back in 2015, which represented 1.7% of the insurance market in California. If you fast forward to 21, they had 66,000 policies, which was 3% of the market. And by the end of this year, they should have around 400,000 policies, which will be an 18% share of the market. So you can see in the last 2 years that their percentage has gone up by 15%. So almost 20% of all homes here in California will be on the FAIR plan, where it had consistently been at 3% or less for the last, 10 years or so leading up to that. So, some really, large increases there. Darnell and I actually were talking this morning, and at his agency, about 18% of their policies are the FAIR Plan. So that, really kind of lined up really closely to what some of the state numbers are on that. So the FAIR Plan, because of those numbers, I mean, they are highly overrun right now with policies and premiums and issues and claims. You can only imagine going from 66,000 customers to 400,000 customers in 2 years. They've had some really exponential growth, so their timeframes are really delayed. I'll let Darnell talk on that more on some of the coming slides, but just to kind of give some context as to why that's such a why they're having such a struggle right now with keeping their service levels up. All right, and I think that's all what I got for this one.
Thanks, Ben.
Yep.
And then we'll go ahead and get Darnell going. Darnell's going to go over some great stuff. So Darnell, take it away.
Awesome. Thank you. Hello, everyone. How are you guys doing today?
Doing good. Yeah, they're
Awesome.
muted, Darnell, so they won't be able to hear you. They'll be able to speak back to you.
Well, I think Ben's already kind of touched a little bit about Proposition 103. And Proposition 103 pretty much states that it's a Consumer Protection Act. So it pretty much prevents the insurance carriers from setting a market that's unfair for the consumer. And it was passed in 1983. It's a great act, but I believe that the current insurance commissioner is using it in a way that's not ethical, or that's kind of hurting the consumer at this time. So back in COVID, when we had COVID, everyone was staying home. They weren't driving, they weren't going out. So the insurance commissioner decided that, hey, why are we charging the same amount of rates to these drivers if they're not causing the same amount of risk? So they forced the carriers to give back billions of dollars in rebates. I received a check in the mail from my insurance company. I know several other people received checks in the mail from their insurance companies. And so they did a good thing by offering that rebate back. But we all know that asset classes have shot up. Cars are more expensive, houses are more expensive. And so now the insurance carriers are saying, hey, we're losing too much money. We can't keep up with the cost of claims. We can't keep up with the cost of labor, and we're now in the hole. Speaking about State Farm lost $13 billion in 2021. They lost $14 billion in 2022. So these carriers are really hurting. And so we go back to the simple supply and demand and supply issues. I know we've heard about the new laws that have been passed in California for fast food workers and them wanting to increase minimum wage. And what does that do? That in turn increases the food or the product that company is going to offer. So this is the same exact situation. Things are going more expensive, and that is going to cause the insurance companies to have to offer a more expensive product. And because of that, it's really the insurance commissioner is using Proposition 103 to say, hey, I'm going to prevent you guys from increasing your rates to protect the consumers, what his concern is. So right now, things are very slow. Under Proposition 103, if there's an insurance carrier can increase their rates by 6.9%. Anything above 6.9% requires a hearing. It requires the insurance company to go before the insurance commissioner and present their facts and their findings on why they need an insurance rate that's above 6.9%. And as Ben just stated in the previous slide, the state actually went for a 45% rate increase. A lot of these carriers are going for 40, 50% rate increases. They need far more than the 6.9% to keep up with the cost of claims. So right now, our first bullet point, we're seeing the premium increase. And that's not from necessarily the insurance commissioner because he's suppressing the rates, but that's because these carriers are trying to figure out which areas in California do we need to take away rate and add it to a different area so that we can maintain profitability. So that's what you guys are seeing. If someone's saying, well, my policy went from 2,000 to 5,000, but you guys are saying that the insurance commissioner is not allowing rate increases, well, that's just because they're moving rate from a different area of California and they're applying it to your homeowner's insurance. And this is the basic principles of insurance. It's called law of large numbers. So we're not just looking at a specific home. And a lot of people say, hey, I've never filed a claim my whole life. I've never used your guys' insurance. I've been with you for 20 years. Why is my insurance going up? It's because they're factoring in thousands and thousands of different risks, and they're trying to spread that risk across tens of thousands of homes. So your clients are going to see rate increases, even though the commissioner is suppressing those rate increases.
Darnell,
Good.
isn't it true as well? I think that if there's like a loss, let's say your State Farm, if you suffer a loss, let's say in Florida for a hurricane, they still take those, types of, losses, the law of large numbers you referenced, and they spread that out over their whole entire customer base, right? So it's not just the fact that, in California, there's fire risk, but as everyone has heard of all these, natural disasters happening everywhere, that is raising the cost for the insurance carriers in all areas, and they're spreading out that cost across their whole customer base. They don't just charge Florida people for Florida damage and California customers for California wildfires. Someone who's got State Farm in Montana is basically paying for hurricane damage that occurred, last year in their premium.
Exactly. And that's one of the things that the carriers are trying to fight for right now too, is like you discussed, that California is one of the only states where they don't future project losses. And so they want to be able to project those losses. In other states, they project tornadoes or floodings. Every 100 years, there's a 100-year flood, and they can project those. So in California, they don't. They just look at past losses and they project future rates based off of past losses. One other concern in California is the underinsurance. This is the #1 E&O claim that insurance agents have. And that's because in many cases, these homes are very underinsured. And in many cases, and this is what I tell loan officers and realtors as well, as insurance agents, we want to insure the house based off of the reconstruction of the home. And a lot of people want to base that based off of the loan. We just need 300,000 because that's what our loan is for. And that's not a good principle we want to apply to making sure somebody has adequate insurance for their property. Inflation has skyrocketed too. So most times we do place a 3% inflation guard on our insurance policies. So every single year, 3% is going to be applied to their dwelling amount. So if they had $100,000 of dwelling coverage, we're going to increase them to $103,000 of dwelling coverage. Inflation has gone so far through the roof. I don't believe that 3% inflation is keeping up with the cost of materials and the cost to rebuild. And so this is a good time for insurance agents to go back to the clients, reassess, the actual cost of their home, and make sure that they're properly insured. Accessibility, affordability, we're all seeing it. We're all seeing these carriers leaving, either that they're suspending business, they're not writing any new business, whether it's home, whether it's auto, or they're completely leaving the state altogether.
Darnell, do you have any examples of how they're making it difficult to get policies? Like if someone wants a car policy, don't they have to also get a home policy at the same time, or vice versa, something like that?
Well, most carriers are not writing home or auto policies. But yes, if you find a carrier that is willing to write an auto policy, usually they're making you email them your copy of your ID, your copy of your registration, photos of the car, photos of the odometer reading. They take all that information in, then you have to submit it to underwriting. They look at it for 15 to 30 days, and then they get back to the agent and they say, okay, this is something we'll bind. You can go ahead and bind the policy at this time. Some homeowners accessibility could be that they want to do an interior inspection, where on most occasions they just go by the house, they do a drive-by, take a few photos, and that's it. Now they want to come inside the home. They want to look underneath the plumbing. They want to look at the water heater. They want to look in the backyard. They want everything to be done in order for them to feel confident in that property. And then in some wildfire risk areas, they'll mandate that you have a fire alarm that's monitored. So some type of ADT system, something that's going to ring out to a third party to make sure that there's another tool in place to help mitigate a fire. So yes, there are a lot of things that are changing, and these things are changing every day. We receive emails every single week stating, "Hey, we're doing this now. You guys," and it's a big headache for obviously us and for the client. And we just try to coach the client to say, hey, this is what's going on. We need to collect this, this, and that in order for this to be a successful transaction. So yeah, there are different tools that are being in place. For the carriers who are still writing business, every week there's some new hiccup or some new implementation that we have to accommodate to, and our team has to speak about to make sure we're all on the same page. Coverage gaps. Coverage gaps occur all the time. I think whether it's with different coverages that aren't included on the homeowner's insurance policy, that would be flood and earthquake. Those are really good, important coverages. I have a big coverage gap that I want to discuss, and that's water backup. We know that water discharge is accommodated on the homeowner's policy, but water backup actually is caused from the main sewer line that's in the street. So for example, when I was with farmers at a farmers insurance agency for about 8 years, I had a client and he actually had a water backup from the main sewer line, and we didn't have a water backup coverage on his policy. And unfortunately, it cost him $20,000, and it was a city issue. The company said, well, this didn't happen within the home. This happened outside of the house at the main sewer line. So he had to fight with the city. The city had to come in and accommodate him in those areas. A lot of carriers now too, what they're doing is they're putting certain limits on their insurance policies. So for example, homeowners insurance, normally you might have water coverage to the limit of the policy. If you had a $400,000 policy, we're going to cover you for water damage up to $400,000. Now what they're doing is we're only going to give you 10% or 20% of water coverage for the dwelling. So if you had 10% of 400,000, now we're only going to give you $40,000 of water damage. So they're little adjustments that these carriers are doing to mitigate their risk. And these are things that insurance agents need to make sure that they're doing to discuss with their agent, discuss with their clients to make sure that with these changes, they're not being left hanging if there's a claim. We did talk about it. Go ahead.
Oops, sorry. Marguerite, I can't see that. I'm sorry. We have a question. She says, I was told someone's home insurance policy was canceled because the car insurance policy was removed, but the person wasn't notified. Is this normal?
This isn't normal, but there are cases where you will need a bundle. Travelers insurance is like that. Safeco is like that. They're not going to accept in this market. In a traditional market, this wouldn't be normal, but in this market, what they're saying is that if we're going to insure you, we need to collect the most amount of premium from you for it to make sense. If we're just going to have your homeowner's insurance and receive $1,000, $1,500 a year from you, for the risk, that doesn't make sense. But if you bring your autos over, if you bring your umbrella over, your life insurance, another additional line, then for us, that is bringing an extra premium, and we can justify that bundle package. So you are seeing that in this market with some of the carriers that they won't accept just a monoline policy. They'll only accept a bundle package.
Yeah, one thing that the carriers are very sensitive to, like let's use State Farm, for example. State Farm has stopped writing new policies, but they have not left the California insurance market, right? Because think of those guys, they have all these captive agents who have offices all over the place with State Farm on the outside of the building. If they were to, no longer do business in California and say we're going to stop doing business here, that would be a really damaging, move for that type of a captive agency. So, but we still are and know of individuals who are receiving letters from State Farm saying that they are no longer going to be covering them for insurance. So the carriers right now are doing everything they possibly can within their own model, for their business model, to remove themselves from certain policies without saying that they're not doing business. So I think, Marquita, this is just an example of, they're trying to reduce their homeowners exposure, and this is a way that they're able to remove that homeowners exposure without coming out publicly saying, we're no longer writing insurance here or there. They just, it's in the gray, so to speak, to help them reduce their exposure. And that's just one way they can do it. But again, it's not typical, and that's why that's why it's done.
And then another quick question, Darnell, I am Ben. Like in my area, I'm in a fire area. And so what happens is you have tons of people like on the local chat boards, like on Facebook or whatever. They're like, hey, I can't get insurance. Does anybody know? And then people are like, well, I have insurance there. Or this farmer's insurance agent over there says they'll give it to me, but the other one says they won't. So we are seeing same companies, maybe in the same demographic offering that. And is that because there's a limit how many an agent can offer insurance policies? So
Yes, it's not a limit per agent. It's actually a limit capacity per zip code. So we have carriers like that, Bamboo Insurance, where within a certain zip code, we're only accepting 5% of the market. We're only accepting 2,000 homes. When that is filled, any new agent that tries to submit or bind a policy in that area is going to receive a message saying this zip code is at full capacity. Once one person cancels their policy, a new agent can write a new policy in that area, but they have to wait until somebody removes themselves from that area for a new agent to write a new policy. So, so I don't know how close the neighbors are to each other, but they do estimate, and I know Bamboo even sent us a map. We have a map we can go to. We can see the concentration numbers of homeowners within a specific area. And if it's at that mark, then they're going to shut off that zip code from new business.
And then we have another question. Does the value of the home come from the appraisal, or does the insurance company assign the value?
The value will come from the appraisal. The reconstruction would come from the insurance company. So, I mean, you can have a $3 million house out in Newport Beach, and it's 1,000 square foot home, but you take that same 1,000 square foot home and you put it, let's say, here in Redlands, and now it's 600,000. So that's where market value and reconstruction are different. We're not basing our reconstruction based off the land. The land I know is part of that market value. We're basing our reconstruction just on the cost of materials, the labors, and the supplies. That's our reconstruction market. Any other questions? Did I answer their question?
Yes, thank you, Darnell.
Mhm.
If anyone has any other questions for Darnell, now's your opportunity.
Yeah, just drop them in the chat for us.
Yeah, and that just goes back to my earlier statement about insurance agents insuring the house properly. And I know some agents come back to me and say, this house is worth $2 million. Why do you only have $600,000 in coverage? Is because if the house were to burn down, that's all the insurance company is going to pay out is at $600,000. They're not going to pay out $2 million. So you're really over insuring the house at that time. So follow up. So each year is a great time. Let me remove this. For your clients, each year is a great time to follow up with their client and recommend they review their policy with their agent, items they should address with their insurance agent. So yeah, I mean, I think every year is a great time for anyone to review the policy. I know that within the process of buying a house, the insurance is impounded. So sometimes it's just a set it and forget it. And sometimes this can be very bad because if you don't have a great insurance agent, he's just gonna let that policy renew year after year after year. In our agency, we want to make sure that we're calling our clients, checking in with them. We go over any changes that they might have, any exposures, any gaps in coverage, because we want to make sure that they're properly protected. And we also want to make sure that we're not putting ourselves in any type of situation on our end. So things to check for, pool or spa. People are always buying, installing new pools in California, any new plumbing or electrical. That's big, the plumbing, electrical, or even the roofing, because those are rating factors. So if you have a new plumbing system, new electrical system, let's say you installed a new roof, those things can help lower the cost of insurance. And then the brush removal. Recently, the California Fair Plan, they have implemented new discounts. So if there's certain brush removal remedies that have taken place, they will afford a discount on your California Fair Plan, which is pretty significant. I don't know the exact percentage, but it does help out the client. So we want to identify any gaps or concerns. So while reviewing the policy, be on the lookout for any gaps or areas where the client may be underinsured. This could include insufficient coverage limits, exclusions that may leave the client vulnerable, or policy provisions that don't align with their needs. One big exclusion we're seeing is that was with roofs. So if a roof is over 20 years old, what they're doing is they're putting a fire and lightning exclusion on the roof. So that means that if there's anything that happens to the roof, they're only covering it if it's a fire peril or a lightning peril. No wind, no water, no snow, no ice. So we want to make sure that these updates are really important to go over with these clients and not leave them excluded. Water exclusions are big. I know we're talking about fires and everyone talks about fires in California, but the insurance carriers are more afraid of water than they are afraid of fire, to be honest. And so we're getting these new notices from these carriers who sometimes if you have a two-story house, they're not going to cover you for water because water damage that starts from upstairs is going to sink downstairs and cause even more damage. If you haven't replaced the plumbing within the last 50 years, they're not going to write the policy. So there's different exclusions that take place. Aegis Insurance just lowered their exclusion. They went from 20% of the dwelling. So if you have $100,000 of dwelling, we're going to give you $20,000 of water coverage. Now they're just giving you 10%. And they didn't notify us. We just went in there and we said, oh, hey, they changed it from 20 to 10%. So you want to make sure that with these changes that the agent is going over these changes. And if there are changes that occurred throughout the year, maybe that's not a good insurance company for that client. Even if it might be less expensive, we don't want to just look at price. We want to look at if that policy or if that carrier is properly protecting that client. The thing too with us is we receive a good amount of feedback from the loan officers we work with and the realtors we work with, feedback from your guys' clients. And so you guys might be the first point of contact when something happens. If there's a claim, if there's an issue, they might reach out to you and say, hey, I had this happen in my home. And I know you guys refer them back to Fast Forward Insurance, but there still is a relationship there. So to be able to have that communication each year with your client is really big and still kind of keeps you guys top of mind for them, for future referrals, and kind of makes you guys a point of contact for future concerns. So provide any recommendations. So if you identify any concerns or gaps in coverage, discuss these findings with the client, offer recommendations for adjustments or enhancements to their homeowners insurance policy that could better protect their interests and assets. I want to, I don't know if that's in the perspective of the loan officer or the realtor providing those recommendations, but you guys aren't licensed agents, so just be careful with how much you recommend, but always point them back to the insurance agent. And if they can't get a hold of their insurance agent or their insurance agent takes 2 weeks to get back to them, then that might not be the best fit for that client. And you might need to find a different referral source, but I'm pretty sure you guys are referring to people that are very responsive, like Fast Forward Insurance, hint, hint. And so we just want to make sure that if you guys don't have an insurance agent, we're here to help and to make your clients feel safe and protected. This is their biggest asset, their biggest investment of their life. And we definitely do not like to see anyone cutting corners. And when we receive insurance policies from other agents saying, hey, this is what my current agent is offering, and I look at it and I say, I definitely do not want to sell based off of price. So I want to make sure everyone is protected, covered, insured. And if anything happens, we know that our carriers are going to take good care of them.
And then I have a couple questions. We have 3 questions, so we'll just go in a row here. Arthur's asking, so my understanding is a non-resident agent may not be able to write areas versus a resident agent.
Correct. So resident agent, so you're within the state of California, you have a brick and mortar. And so they're going to prioritize those agents more than non-resident agents. And we're licensed in 13 states, Fast Forward Insurance is. But with the amount of restrictions that are going on in California, a lot of agents are trying to find appointments in different states. And so these carriers in other states are trying to protect those agents in those states. And what they're doing is they're saying, well, you have to have a brick and mortar in order to do business or write through us. You can get licensed in Nevada, you can get licensed in Texas, but then I need to get appointed with a Safeco or get appointed with the Mercury. And Mercury might say, hey, you need to have a brick and mortar in order to gain an appointment with us. So there are different restrictions that we're finding where, Safeco, I can write through all 50 states. And now Safeco has shut down our access in all 50 states, but California. And so those are the restrictions that are being applied if I'm understanding the question properly.
Thank you. And then Jesus has a question. He says, I have a scenario where an investor's insurance has doubled. It's valued around 500K in the Central Valley. It's a fourplex. The insurance says the cost to replace, though, is 1.2 million. Are there ways to keep the insurance carrier from overestimating?
Um, I don't think overestimating, but if you want to gain a second opinion from a different insurance company, I find that with in your guys' business, it's good to refer to multiple insurance agents. And sometimes they'll even send you the same exact company. That realtor, that loan officer might receive, two bamboo quotes from two different insurance agents, and then they can kind of match up to see where are we falling. If I send a quote for 500,000 in coverage, and the other agent sends a quote for $1.1 million in coverage, there's something wrong there. But I think if you just gain multiple quotes, you can kind of find an even middle ground. Within the insurance coverage, there also is an extended replacement coverage. So we'll cover the home for the value we believe it costs to rebuild a home, but there also is a 25% gap coverage above that. So, for example, if you had $500,000 of coverage, that's what we believe is going to rebuild the home. But let's say the house burns down, unfortunately, and materials are more expensive, and they come back and it's going to cost $575,000 to rebuild the home. Well, that gap coverage is going to extend above that 575,000 in order to give that peace of mind. So every agent quotes a little bit differently. No agent is perfect. Depends on, we pull in county records, county specs, but then after we do that, we make certain adjustments. Hey, county specs pulled over 3 bedrooms. This is a 4-bedroom. County specs pulled over a slab. This is a crawl space. We make different adjustments and we let the system spit out its estimate. And that shouldn't be too far from the next agent. So unless you believe it's just too far, too much coverage, then I think you should just get a second opinion from an agent and see where it falls there.
Darnell, was there a certain tool that you guys use in your business to provide the estimated replacement cost?
Value 360 is the most common one. That's implemented within most of the insurance carriers. There are several other estimators, but Value 360 is the most common estimate. Yeah. And that's what we provide to all the realtors and loan officers during the closing. They want to see that estimator and make sure that we're evaluating the property properly.
And then we have a couple more questions here. Thank you guys for all these questions. This is great. So keep them coming. And then Ruth is asking, she says, as an agent, do you contact the homeowner annually at the time of renewal to discuss the policy and potential changes to premiums and coverage?
Yes, we do. I can't say that every insurance agency does, but we do. We do have a list of questions that our customer service goes through with them. And we ask them if there's any changes to the home. Do they have any additions, new children? Have they made any additions to the home? Any discounts we can offer them? Fire alarm, burglar alarm, any updates, plumbing, roofing, any other vehicles or assets that are insured with other companies that they would like to see if there's a bundle option over with us. So we do have a list of questions that we go through with our clients. Not everyone gets back to us, but we do send out an email, we do send out a phone call, and we do make that available to them if they would like to have that conversation.
Perfect. And then Lisa has a question. I have clients adding ADUs. What are some important pointers we should be aware of?
With the ADUs, if the ADU has its own number, it's going to require its own insurance policy. But if it's just an ADU, if there's no separate identifying number, then just make sure that the other structures within the insurance policy is sufficient to cover that ADU. So in most insurance policies, 10% of the dwelling is the coverage for the separate structures. So if you had $500,000 you're insuring on the home, we're going to give you $50,000 for other structures. That could be detached garage, that could be storage units, fences, an ADU, but that ADU might be more than $50,000. So we want to make sure that we're increasing that other structures. Maybe it goes from 10% to 20%, or the agent can just calculate based off of an estimate if they want to go based off of square footage. Or sometimes I'll do research and how much does a 800 square foot ADU cost, and I'll add that to the other structures to make sure that they're covered. So you want to make sure that when we're insuring these things properly, that we're not just allocating that coverage to the main dwelling coverage, that we're allocating that coverage to the other structures coverage.
Awesome. And then Sal is asking a question, and I kind of know the answer, but I will let you gentlemen answer this. If a guest from today found this information informative, would they like this presentation and they would like this presentation offered at their office meeting via Zoom, would you consider a private presentation?
Oh yeah, of course, of course.
Yes. And then
course.
if so, should they reach out to the person who invited them? And I would say yes, Sal. I'll answer that one. Yeah.
Okay.
So yeah, we're definitely, I know Ben and Darnell and are more than happy to offer this, and just, get their schedules together so they can do this. We want to really be a partner with you guys and be informative. So, and be able to help you guys with everything to get loans closed for you guys. And
That's it
any
for me
other
on this
questions?
side.
Yeah. And then I'll jump into the next slide because I'm going to kind of, Ben, you guys can feel free to jump in here as well. It can be kind of all three of us. So the next slide that we have is what can you do? So like, what can you do as a real estate agent to not have any pitfalls in your transaction? So we want to make sure that the loan officer that you're partnered with or yourself, you're not waiting too long to get quotes, binders. And Darnell says that is like one of the biggest things. You want to get them early. That's why we have 2 exclamation points there.
Yeah, we used to be able to
And-
get insurance like if someone forgot and all of a sudden we're at closing, we didn't have insurance yet. And we're talking, 10, 15 years ago, we could have an insurance policy, quoted and bound within, half of a day. And
Yeah.
that's just, in most cases right now, if you've got any home that's got any sort of tricky situation, that's not the case. And if you need to go with a fair plan, I mean, Darnell, you're seeing transactions at the fair plan. You said what, 3-4 weeks to get a fair plan back.
Correct. Yes.
And that's if
yeah,
you do
so-
it right the first time with them.
Right, exactly. Yeah, so I would even receive a quote from your agent before they even go into their transaction. So we do this a lot. They might not even provide us the name of their client. They just want to say, hey, can you do a quote and see if this falls within the California Fair Plan, or we want to see how much it's going to cost. So if you can reach out to an agent and get those quotes even before you go into the transaction to keep your client informed, that's great. And then when you do go in the transaction, we do want to begin that application process immediately, because if it does fall within the California Fair Plan, and Ben stated every year, and this year especially, we're expected to have 20%. California Fair Plan is supposed to have 20% market share. More and more people are going that route, and we're seeing that the turnaround times are 3 to 4 weeks. We used to get California Fair Plan applications back within 24 hours. And then it was 3 days, and then it was 7 days, and now it's up to 3 to 4 weeks. And so we just want to, be ahead of the curve and make sure that, I know a lot of these are 30-day escrows, and if we're talking 3-4 weeks, we're cutting it pretty close on that front.
And I think another thing is, even as a listing agent, getting this information, before you list the home might be, a great avenue. And there is and Darnell, you can touch on this too. A lot of times we have people who are looking at buying a home and they think, oh, well, I'll just get the policy that, that the buyer, that the sellers have. Well, we all know that that doesn't always work. Or, you know what? I know that my insurance company who does my auto insurance, oh, I'll just call them. They'll get it going for me. And that can cause a lot of delays. I don't know if you want to touch on that more, you can. That we can't assume that just your auto company is going to be able to cover you, or whoever's living in the home now, that insurance will also cover the home, because they may not be writing new policies, as we've gone over.
Yeah, that carrier might have a 5% limit on that zip code, and they're currently sitting at 6%. And so when that home sells and that policy cancels, they're more than happy to allow that to not be renewed or to issue a new policy, because they're trying to get down to that risk level that they're trying to obtain.
And then one of them is request a loss run report. Darnell, do you want to kind of go into that one for us?
Yes, I apologize for any additional noise in the background. So requesting loss reports is key as well, because if there's a claim on that property, that's going to cause additional underwriting concerns. So these underwriting concerns too is for example, bamboo. If there's any type of loss, they want to see an inspection report. They want photos of the property. They want to make sure that any damages that were previously reported have been mitigated and fixed. And once you submit those reports, they're saying it's going to take 3 to 4 weeks for them to review that and then get back to us to say if this is a bindable quote or not. So as soon as we see a loss on some of these companies, we just forget that. We don't move forward with it. We don't even try to bug the loan officer or the realtor for this information, because most likely we're not going to meet the deadline. This is the only problem with giving us a property without an insurance name, like I discussed previously, is because we have provided a quote just based off of a fictitious name, or maybe we put the name of the policy or the quote underneath the loan officer's name. And then when we went to go actually put the quote underneath the borrower's name, it popped up several losses because they had filed a claim at the previous house or previous location. And we kind of, got a little bit of a surprise at that point. But we need to make sure. Go ahead.
Darnell, does that mean that if a seller is selling a home that they themselves had a claim, that would show up on that loss report, and that would be applied to the new buyer buying the house that had the claim on the home they're buying, right? So,
exactly.
But the other side of that is if you have a buyer who let's say sold a home a year ago and they're buying a home today, and that home they sold a year ago, they had filed claims themselves, that also would bring further risk into the transaction as well, right? So if either party, buyer or seller, have had a claim in what I think it's the last 5 years, is that on average is kind of what they're looking for. And it's important to know that, because that typically does increase the quote that they're going to receive.
Correct. Yes. And even if the claim there was nothing paid out, we see that too. There's a claim and it shows a zero payout. They still will look at that and say, hey, there's a concern here. They called us. They did file something, even though they didn't move forward with the claim. They're still caution that we need to apply to this property. So they're going to want to see, either statements from contractors, receipts, statements from the previous insurance company, showing the loss has been taken care of and fixed to quality standard. And that is going to take weeks for some carriers to go through and approve. So we don't want those surprises. An agent can give you a quote and say, hey, look, I have a quote. And then 2 weeks later, when you go to bind and close your transaction, the agent goes back to you and says, oh, something popped up. I'm sorry, we can't actually give you this insurance policy. Now you're scrambling around trying to get the fair plan, and you're stuck, waiting on the fair plan as well. So no surprises is a good reason why you should get those loss runs taken care of early.
Yeah. And then obviously we've touched on, we don't want to be underquoting insurance premiums. It's better to be fully covered for your borrower, your client up front. And then also making sure you're working with a loan officer that is going to go over the budget concerns of the loan. For example, if you have a borrower, and your loan officer knows they have extremely tight ratios, and then they're like, hey, I want to buy this property, and we know that it's in a fire territory. Those are things that, your loan officer and at Mountain West, we are going to be on top of those things to be able to let you know, like, hey, this may be an issue, this property. And, just as long as I think the agent and the loan officer, we're all on the same page by, doing these things up front, then we don't have those issues at the end. We did go over not making assumptions, assuming you can get the same insurer or insurance as the owner of the home. And we went into that in great depth. And then also being prepared that some lenders require proof of both policies. So Darnell, I know we had talked about this when we were planning this. If you have anything to add to that about where the lenders, go ahead.
Oh, for the California Fair Plan and the supplemental policy? Yeah, so it goes back and forth. In the past, we've had some lenders not allow the client to have both policies impounded, saying we only care about the fire portion. So if you want to have the supplemental or the DIC portion, difference in conditions, half of your policy, you'll have to pay that separately outside of your escrow or impound account. But recently now what we're seeing with some lenders such as PennyMac, they're not accepting the insurance policies without having both. So we've tried to do it where they just want to go with the California Fair Plan. It's so expensive. Let's just go with the California Fair Plan. We've even agreed with the client that we'll take care of the supplemental policy outside of escrow, so that way it doesn't hurt their ratios. And then we get a notice back from the broker saying that PennyMac, no, they want the supplemental impounded. They're not going to move forward without having that difference in conditions. So, so yeah, altogether, it's good to have both policies, but we are seeing that the lenders are seeing the importance of having it and are requiring that.
Perfect. And then we have a couple people saying thank you. Elizabeth, thank you for the great information. And then Sylvia says, thank you for this great information. Why is it that some Mercury brokers are no longer accepting policies, even if you have a policy with a different Mercury broker to bundle everything under one umbrella?
Mm-hmm. So Mercury, they haven't given any appointments for, I don't know how many years, maybe 7, 8 years. They haven't appointed new agents. And so what's going on is it goes by territory too. Either they're suspending certain Mercury agents or they're actually terminating Mercury agents. And it might not be direct Mercury agents. It might be a broker like me or an independent agent like me who has a Mercury appointment. And they're just coming to me and saying, hey, Darnell, we're going to put your Mercury appointment on hold. And they might only allow certain Mercury agents to keep their appointments, either because they have a certain size of a Mercury book, or they've been grandfathered in. They've been with Mercury for 20 years. So they pick and choose. Mercury's one of the biggest companies that do that. They're very restrictive on who they appoint, and they're really quick to cut people who are not producing, or smaller agencies who they feel aren't bringing in enough premium for them to justify that appointment. So hopefully that answers your question. For example, with Bamboo Insurance, if you hadn't written a certain amount of premium with them for the last year, they terminated you. So we write a lot of premium through them, so they kept our appointment. So companies are picking and choosing what agents they want to keep and what agents they want to kind of push away.
Perfect. So we're a little bit over our time frame, so we appreciate you guys being here. So if there's any other final questions, feel free to ask. If not, we will start to wrap it up for you guys so you guys can get back to your busy days. And so I'm going to go ahead and start closing it. But if you have a question, I'm here looking at the chat box at the same time. I want to thank everyone for attending. Thank you for being so engaged with those great questions, great information. Thank you, Ben. Thank you, Darnell, so much for your time and your insight. all your expertise. It's just great. I've learned a lot just from doing this with you guys. So again, we always want to be able to support our partners. And thank you so much for attending. And I don't know if Ben or Darnell have anything they want to close with.
Oh, nope. We're just happy to share what we know with you guys. And if you have any additional questions or any information you're looking for, please reach out to the loan officer who invited you, and they can always get you in touch with us or answer your questions. And, we appreciate your partnership, and good luck with the rest of 2024.
Yes, let's do it. Thank you very much. You guys have a great day.
Thank you.